Good afternoon and welcome to today's program, Optimizing Real Estate for Your Business. This event is brought to you by the Pacific Northwest Defense Coalition, PNDC, and Cushman Wakefield. First, we want to confirm all those joining us online can hear well and see the screen. Just type yes in the question field if you are all set. Please feel free to use the same question field to ask a question at any time during the program. Type your question in the webinar dashboard and we will share it with the speakers. Please use the Handouts tab for your copy of today's presentation and a list of upcoming PNDC events. We're delighted to have two of your fellow PNDC members joining us today. They will share their considerable expertise to help optimize real estate for your business. We look forward to a discussion of owner versus lease options, tax implications, adapting to changing needs, and other real estate challenges. Our speakers will be Matt Johnson, Managing Director, Office Brokerage, and Aaron Watt, Director, International Brokerage. Matt Johnson maximizes clients' real estate objectives by providing short and long-term strategies and solutions to achieve their business goals. Working with companies on a local, regional, national, and global level, his team provides consulting and brokerage services for companies evaluating, expanding, and contracting supply chains, and buying, selling, leasing, and subleasing space. Aaron Watt focuses on industrial and flex properties and helps clients with requirements locally and globally to identify solutions that support short and long-term business objectives. He takes a client-focused approach and provides services on new leases, renewals, and building and land sales. Thank you again for joining us. Please begin the presentation.
Great. Well, thank you for the introduction, and this is Matt speaking. Thank you those who joined us, especially after an interesting start to 2017 with some heavy snow in the Pacific Northwest. So we'll go over an agenda of what we want to cover today, and then look forward to any questions that you may have at the end of the presentation. So in short, we're biting off a lot of information here and trying to cover as much as we can in a short amount of time. So we'll try to stay pretty high level, but if you have a detailed question at the end of it, we're happy to follow up. Really what we're going to be talking about is a process that we use to help clients develop an understanding of where they are, think strategically about their real estate, analyze options, and then be able to execute on those options. And when we go through this, we'll be using a few case studies for clients where we've helped them through this process. And then we'll open things up to question and answers. So for start, one of the themes that I think you'll hear throughout this presentation is we always encourage business owners, companies, to evaluate their real estate on a consistent basis. It doesn't mean they have to do anything with it, but to be proactive in their approach. Oftentimes, some of the triggers that companies have to look at the real estate or evaluate the real estate, growing, consolidating or contracting, changes in technologies, changes in business needs or demand, potential opportunity that sometimes they just drive by and see, merger and acquisition or market trends. So we put together a four-step process that we use to help develop and implement a proactive real estate approach that's centered on really understanding what you have, what potential opportunities are out there, being able to think strategically and define a focus around those opportunities, completed a detailed analysis so that you've objectively evaluated all criteria and you know how it's going to impact your top line, your bottom line, and your employees. And then a negotiation strategy for accomplishing it. Great. So to start, the first phase is discover and develop. This is where we suggest completing an initial market overview for people who lease space. It involves a lease abstract, which not only details the legal terms, the business terms in the lease, but also takes those terms and marks them to the market so you understand your relative position in the market. For example, as rental rates have increased over the last few years, oftentimes when we meet with people, we find that they're in a relatively advantageous place in the market, or they're paying today below what we would define as a market rent. Real estate is cyclical, so it depends on when a lease was signed, the deal terms that were negotiated at the time. Also, we use a tool called the broker opinion of value. Broker opinion of value essentially identifies if you own a building, how much that building is worth, and in some cases, if there's a higher and better use about it. In this phase, we also, depending on the scope and the needs of a potential business, work with them to interview employees, identify if there are ways that their competitors are utilizing real estate to get a competitive advantage in the marketplace, and try to think a little bit about how we can help, or begin thinking a little bit about how we can use real estate to help further some of our clients' larger business objectives. Great. So this dovetails into thinking strategically. There are a lot of different options for people as they consider real estate. You can own, you can lease, you can do a build-to-suit, you could potentially consolidate, you could relocate from one suburban location and do more of a core location, or vice versa. In this phase, really we take everything that we've heard in the first step and understood, and do some initial high-level scenario modeling. This involves some back-of-the-envelope financial analysis, some feasibility modeling to see if the solutions that are being identified and modeled can be achieved in the market, especially a market today that has less inventory than we've seen in the past few years. And the optimal outcome at this step is to identify real estate solutions, gain some focus on those solutions to support and improve business functions. For example, working with a client recently, once we developed a thorough understanding of their needs, their relative position in the market, and then working with them to figure out what scenario looked the best, own, lease, build-to-suit, we were able to help them identify that because of the flexibility required, they really wanted to enter into a lease situation, a short-term lease situation, to give them flexibility to adapt to changing, their anticipated changing future need. As a result, we were initially able to focus our time on creating these solutions and providing more options and more opportunities for our client, rather than kind of running in 5-10 different directions and putting everything in front of them. So we think from our standpoint, it certainly helps us create more options for our clients. For our clients, it provides them more exposure to these opportunities, but it also saves them a lot of time, so they're not out looking at projects that at the end of the day really aren't a good business decision for them. Great. So the step 3 is where we analyze these options, or we take these options and put them under a microscope. There's a qualitative component that can tie back into interviews with employees, potential impact on commute, parking, the cost of parking, traffic, and employees being able to get to a location relatively easily. Of course, there's always the numbers and the quantitative side of it, both the cost to lease or acquire space, if improvements need to be made to the space, and any potential capital outlays that are associated with that as well. There's also what we refer to as the business costs or the business implications associated with a real estate decision. Will it impact your top line or your bottom line? Are there tax implications moving in and out of one county or a state that can be associated with it? And how will it impact retention and recruitment in terms of making it an enjoyable place for your employees where they can be effective, be efficient, that they can get to as well? So what we thought we'd do now is jump into a little bit of scenario modeling and provide some case studies for, if you were to do nothing after you've taken a look at this, and if you lease your situation, maybe you go to the market and generate some leverage, try to get better terms, extend your lease. If you own your building, you don't do much today because you found out that what you have works for you well. Or we looked at a scenario where renew, lease, and reconfigure your space to match the new needs, or relocate into a new or existing building, whether you buy it or lease it. So we've put together over the next few slides kind of the pros and cons of each, and we're going to use more of a case study format to describe clients that have selected this particular option, talk about the pros and the cons, and really the why behind their decision.
So typically under a do-nothing approach, we see that a lot with groups that they own their own building. In the market today, there's limited options in the market. There's very little vacancy. And business demand might be stable. They might not really have any big changes forecasted for business. So under a do-nothing approach, there is no capital expense really today. There's really no additional commitment required for taking on additional space or making any sort of a move. And there's very minimal, if any, business disruption. Things would continue to go on as is. But, there are some things there that, that could be perceived as negatives. You may not be able to match your needs long-term or within, short or long-term to changes in business needs because you're stuck within that specific square footage. There is no additional right of first offer on additional space, or you haven't talked to the neighbor maybe about acquiring their building, for instance. There could be, under a lease scenario, the possibility of significant rent increase as you come to the end of a lease. And if you haven't really taken the time to think about that or given yourself 8 to 12 months prior to evaluate your situation, you might not have enough time to relocate under that type of a structure. And then typically under a new lease scenario or relocation, you would also have the ability to probably achieve some tenant improvement allowance dollars provided by a landlord. And should you stay in your existing space or should you not do anything, those dollars typically are not available. And then lastly there, as we kind of hit on the top con, is you would not have any available room for additional growth as that need comes about.
So we'd note that there's certainly nothing wrong with doing nothing, but it is a conscious decision. And we find that clients that select this have gone through, they've evaluated it, they've analyzed it, and they've said there's nothing out there that is better than what I have today. So in a perfect world, it's a well-informed decision. So the second scenario that we're going to be talking about today would be a group looking at renewing a lease and reconfiguring space. So we can talk a little bit about a case study for a client that we worked with in a suburban location in Portland that was evaluating renewing their lease versus relocating into an alternative building. The location they were in worked for them. The challenges they had and why they were looking at other buildings, not only to generate the best deal with their existing landlord, but also they had a little more space, a little more warehouse space than they needed, and a little less office space than they needed. And there were some power improvements that needed to be made to the building to allow them to put some new technology improvements in place. So we evaluated the renewal options. We looked at making the improvements. We evaluated the relocation option. And at the end of the day, they decided that their existing location worked better for them. But through the process of going through and looking at alternatives in the market, we were able to save them 24% off their then lease rate and get all the improvements provided by the landlord at no cost to them. They did commit to a longer lease extension in order to make these improvements possible. However, we negotiated a termination right, which let them be flexible to any changes that may come that they didn't foresee that may come in the marketplace. And from a long-term standpoint, we did secure the right to be able to expand onto the building so that if they did need additional expansion space prior to the lease expiration, that was able to be accommodated without a relocation. And they had minimal workflow disruptions throughout this project. They didn't have to relocate or make any significant infrastructure improvements to a new space. They retained a lot of the value to the existing improvements that they had, especially in the manufacturing portion of their space. So relocate into a newer existing building buyer lease. Oftentimes, a trigger point for this is groups are expanding, or they have multiple locations and they want to get all of the locations under one roof. Recently, we worked with a group that had an office location in downtown Portland, and they had a warehouse location in a suburban area of the market. They had a lot of challenges because people were split between two locations. There was a lot of travel time for meetings, or a lot of meetings took place over conference call, and they didn't feel like their employees were being as effective as they could be if they were all under one roof. Additionally, the downtown people not only had to pay for parking, but not everybody received a parking spot who wanted it, and they were paying a pretty high rate on a per square foot basis for office space that they felt like they could reduce for a suburban location. They leased both the suburban warehouse location and the downtown office location. We identified that through consolidating both functions, they could increase space efficiencies, as well as they identified improve their effectiveness of their employees at the business. But it resulted for a cost-neutral solution for them to actually purchase a building over time. So they purchased the building, they solved the problem of the parking. They now have people that are working together and working in a much happier, more efficient environment. This can be done both from a buy, as was this case, or a lease. And typically find clients that do so because there is a need for expansion, contraction, or a co-location.
Yeah, we definitely see this with a lot of industrial users right now in the market, because there's a lot of businesses going well. There's a lot of demand. Folks are expanding. They need more warehouse space. They need more production space. Similar to Matt's example, we have a group that we're working on a project with right now that had grown out of their manufacturing and warehouse space, which was a combined space, and they leased a separate warehouse for product shipping and receiving. And it was just down the street, but as they've continued to grow, they've found that consolidating that into one facility would be much more efficient. Would reduce labor costs, reduce transportation costs. And so we're in the process of completing a transaction that would move them into one, combine them into a new facility. And within that, too, they had a lot of, they've been in the manufacturing facility for a long time, so this is going to allow them to integrate new technology into the space, not only on the manufacturing side, but also on the office side. And they're going to achieve some utility efficiencies by being able to get into more efficient, energy-efficient lighting and other energy-efficient components of the building as well.
So the last step, once everything a decision has been made, is executing that decision. And that's not only developing a negotiation strategy to get the best terms, As I mentioned earlier, even if you've pre-identified relatively early in the process that a renewal is the best option, if you don't go through the steps of leveraging alternatives in the market, then you're not able to achieve optimal terms. But it's also finalizing the transaction structure that's most advantageous for a group. We always recommend having, from our standpoint, we see a lot of leases. We review them from business points. But it's always helpful to have a lawyer review a lease or a purchase and sale agreement to make sure that there isn't any ambiguity and that the language is fair or in your favor. So that in the event you have to look at a lease or you're waiting to get a purchase and sale agreement finalized, there aren't any issues holding that up. Great. So we talked about a few things today, and there are a few things that we didn't speak to as much in detail that we're hopeful to follow up on in the fall. And that will be incorporating a little bit more about some of the legal pitfalls associated with real estate, as well as FASB. The way that we're accounting for leases and the tax implications and how leases are carried on business books is likely going to change, and that is probably a presentation in itself. But getting ahead of that and knowing how those changes may impact your business so that the decisions you make today, you're aware of the potential impacts they can have down the road is important. What we did talk about today, I think, again, the overall theme is having a proactive approach, and that's not waiting necessarily until there's a driving need to just develop an understanding of where you are today. It's trying to, through periodic annual market updates on if you own your building, what it's worth, your relative position in the market, if you are leasing space, and overall trends of what's happening in and around the Portland market. Having that readily available on an annual basis is helpful, because when there is a need to make a decision or a need to evaluate something, it can help that process be a lot more proactive rather than reactionary to the market. Great, so that's all that we had today, but we'd love to open it up for Q&A and hear what questions we may have.
Wonderful, thank you. That was a lot of great information. So again, for attendees, if you are not able to see the dashboard on the right, you might see just a little red or orange arrow at the top corner of your screen, but we invite you in the questions section of the dashboard to enter your question. And I'll get started. What advice would you have for someone who's just starting to think about their real estate?
I think the first step, and Erin, jump in, is to get an understanding on what you have today, and then trying to think about in a perfect world what you would want. Oftentimes when we walk into a situation with a client, they tend to focus on, this is exactly what I have, and here are some ways I can make what I have work, and then they benchmark everything based on what they have, rather than saying strategically, what do I want, and then how can I put a strategy together to help me achieve that?
I think the information gathering is really important. A lot of times within that, a lot of stuff seems obvious because you're just looking at the physical space, but you do uncover a lot of facts that, when kind of matched with market trends and market information, can open up opportunities or areas for further discovery.
All right, great, thank you. If I'm leasing with several years remaining, when should I start evaluating?
Well, as Matt had mentioned earlier, what we usually recommend is always evaluating on an annual basis, because it does lead to definitely a more proactive approach, and you don't get stuck in a position where something comes out of the blue that's a change to the business that you have to create the wheel from the beginning, and you have somewhat of a plan and an idea of where things are in the market. But typically, I think at a minimum you'd want to be looking at that probably 18 to 24 months out to be able to see where the market is and where your lease is relative to the market at that time, and then kind of continue to check on that based on how things are going with your business. If you think you're going to be needing more or less space, within every 6 months, and be talking with the consultant, and probably at least 12 months out from there.
Yeah, but the only thing I would add to that is, depending on where you are in the market and the company's position, oftentimes I mentioned the case study where we were dealing with a group that was looking at restructuring their lease or relocating. Because we were able to start, we started 36 months in advance of their lease expiration, and they were a sizable tenant, so it made sense to do so. We were able to execute the lease 18 months prior to their lease expiration, which enabled them to get the improvements much sooner, so they could benefit from the improvements in their process much before the lease expiration.
Yeah, I guess going even one step further then on that would be, if you have a need, it's never a bad time to look at evaluating your lease.
Yeah.
If you just signed a 5-year lease and you're only in 12 to 18 months in, but you have a need, there's always ways and opportunities to work through that and be able to tailor things that could be beneficial for you.
Okay, and along those lines, what's a good method to determine the market rate for my building or for a lease? And what does it cost to find out how much the building's worth?
We do offer a broker opinion of value, which was referred to in that. And through that, we would go through and evaluate the value of the building through a couple different types of valuations, through an income approach and a sales comparable approach. And that's something that we do at no cost to folks to be able to give an understanding of where your building value is relative to market.
And sometimes you don't know what you'll find, whether it's a lease situation and marking the lease to market through using recent experience we have with similar type products or similar leases, which gives us relevant information, or a broker opinion of value, as Aaron mentioned. Recently we worked with a group that was having problems with congestion. They had a close-in southeast side location, and just because of all of the changes in use and gentrification of that area, it was making it difficult for them to perform business. The silver lining there was they were able to sell their asset for a higher and better use at a significant profit, relocate to an area that fit their business needs better, a little bit farther outside. I wouldn't say suburban, but definitely farther away from the CBD. And not only was it a better business solution, but the owner of the business put a pretty good check in their bank account as well.
So kind of on the other side, what strategies do you have to limit lease rate escalation?
Sure. So I think it's a good question. There are a few strategies that we have to do that, and every situation is unique. It depends on what somebody's relative position is in the market. But in short, the negotiation strategy always involves creating a legitimate alternative, telling a believable story, and then creating a campaign of competition. And if you don't do that, and you're negotiating with the landlord trying to keep escalations low, you won't get the best results. That said, the exercises that we do, or the analysis that we do, where we mark leases to market to show, are you 5%, 10%, 20% below market, even if you do them, as Aaron was mentioning, 2-3 years out, can give you a a good expectation planning going forward on if there may be an opportunity for an escalation. But dealing directly with one group, trying to limit your risks and just negotiating in a vacuum, that's a strategy that we found not to be very successful.
And are there any other factors that you think are commonly used to negotiate lease terms against tenant improvements? Not quite sure if that translates.
Well, I think what we see a lot is that there's a couple different buckets that the tenant improvements go into from a landlord's perspective on the industrial side. And if you're when you're leasing, a landlord looks at those and says, oh, do those have some residual value to the building, and are those things that down the road, another tenant might use, or that that would be good for the building? And then what are those improvements in the other bucket? Are those very tenant-specific improvements? And as the market sways from tenant to landlord-sided, in a landlord-sided market, it's a little bit more challenging to get some of those tenant-specific improvements funded. But you can still do that, like Matt said, I think by looking at alternatives, leveraging those alternatives, and creating a campaign to do such. But another avenue, I think also, what about on the office?
Well, I think in general, the longer term you're able to provide a landlord, the more willing they are to give you a substantial tenant improvement allowance. It isn't to say that if within the business plan there is some uncertainty. So as I mentioned before on one of the case studies, a group needed significant tenant improvements. Rather than complete a 5-year transaction and have to come out of pocket and pay for a portion of those improvements, completed a 7-year transaction with a termination right at 5, the cost being the unamortized tenant improvements and other fees associated with the transaction. But they planned on, they made a decision, a strategic decision, to get them what they needed today using the best information they have today. But we built in a safeguard that if things would change, they would be able to eliminate the majority of the remaining obligation after 5 years. So, and that's a trade-off that we, it's a double-edged sword. It's a trade-off that we find in our industry is if you want tenant improvements, the landlord wants typically a longer term. And as Aaron mentioned, we always try to frame the tenant improvements as adding overall value to the building, so that even at the end of the lease, if a tenant were to vacate, a landlord is left with something that they feel is better than what they have today.
Perfect. Thank you, gentlemen. Doesn't look like we have any other questions from the audience, but I'll give them just one last second to type in any other questions. Does not look like it. Any last parting thoughts?
No, I think we took there's a lot to cover on this topic. We took a broad brush stroke. We welcome any feedback on areas that would be particularly of interest. But there's certainly crossover in our industry in dealing with accountants and lawyers. And if the audience felt that maybe there was a more defined topic where we could dive in a little deeper, or an area of this that was of more interest, we'd welcome that feedback.
All right. Well, thank you again, Matt and Aaron. We appreciate you sharing your considerable expertise with us, and thank you for everyone for joining us online. Do make sure to look for upcoming PNDC events at pndc.us, including a networking lunch at Enoch on January 26, 2017, a roundtable with U.S. Congressman Kurt Schrader in Oregon City, and many more events that are attached to our event sheet on, again, the dashboard where you were posting your questions. And if you'd like a copy of the presentation, it is also included in the handouts portion of the dashboard. Again, we look forward to seeing you at another PNDC webinar or event in the near future. Otherwise, go and have a terrific day. Thank you.
Thank you.